Okay, let's just dive right in. If you've been watching the Bitcoin market at all recently, you know exactly how the last few months have felt.
Oh, yeah. It's been a roller coaster.
Absolutely. We went from those, euphoric peaks challenging $126,000 to this dizzying correction.
Yeah, a real gut check moment for a lot of people.
For sure. And now here we are. It's December 6th, and we're looking at a price that's just sort of hovering right around 89, 90, let's call it $90,000.
89,904 to be exact. But yeah, basically 90K.
And if you're tuned in, you've probably been asking the exact same questions everyone else is asking. Was there at the cycle top?
Right. Is it over?
Exactly. Did we just witness the end of the whole rally? Is this volatility just going to keep going?
And that feeling you're describing, that mix of confusion and, frankly, stress, that's classic market psychology. It's what happens after rapid volatility.
But this is what's so fascinating about the stack of research we've been given for this deep dive. It argues that this volatility, it wasn't random noise.
It wasn't chaos.
No. It was, and I'm quoting here, an inevitable mid-cycle structural reset.
Right.
They're saying it was a required, necessary cleansing.
That's a huge claim. It really cuts against that prevailing feeling of panic,
It really does. So our mission today is to go deep, deep into the underlying data. We're talking the on-chain metrics, the actual cost basis of every buyer, the derivatives market structure, and really try to verify that claim.
We're hunting for structural integrity.
That's it. We want to solve this puzzle. Was this volatility a fundamental, necessary cleansing of supply, or was it just a very, very expensive bull trap?
And we have to start by examining the evidence around what this research identifies as the Great Wealth Transfer.
The Great Wealth Transfer. It sounds so dramatic.
Well, they characterize this as the most significant transfer event since the ultimate market top back in 2021. So, yeah, it is dramatic.
So what does that actually imply?
It implies that the entire ownership structure of Bitcoin has been fundamentally altered, completely changed, in just the last few months.
Moving from whose hands to whose hands?
From the hands of the most veteran investors to the newest ones.
Okay, so the stakes are incredibly high then. If this is a real transfer, it means the foundation for the next leg up is being built as we speak.
But if it's just a bull trap, then
we're due for another big drop. So the big question we need to answer is pretty simple, right? Has the heavy organic selling pressure truly reached what the sources are calling absolute exhaustion?
Or is there still this massive accumulated supply just sitting there, waiting to be purged out of the system?
Right.
And that leads us directly to the core tension we have to analyze today. Because if the veteran sellers really are finished,
then the problem isn't them anymore.
Exactly. The immediate challenge is no longer about them. It's about the conviction of the newest buyers.
Yeah.
The people who bought the recent dips. It's about their willingness to hold their positions.
And this whole battle is taking place while the derivatives market has become, what, loaded with fuel?
Completely loaded. It's packed with leveraged short bets, creating this potentially explosive fuel for a massive short squeeze. So we need to identify the immediate structural resistance point, which the sources pinpoint with a stunning precision at $104,685.
$104,685.
Yep. And we're going to explore exactly why that specific number is the market's new ceiling.
All right, let's start at the beginning then. We need to solve the first part of the puzzle, the supply cleanse itself. To really understand this stabilization we're in, we have to look at the behavior of the largest, most critical cohort, the veterans, the long-term holders.
Absolutely. And when we talk about LTHs, or long-term holders, we have to use the specific on-chain definition from the research. An LTH is defined as someone who has held their coins for 155 days or more.
Okay, 155. Why that number? It sounds a little arbitrary.
It's not, actually. Historically, on-chain analysis shows that 155 days is the threshold where the probability of a coin being sold drops dramatically. It's the point where coins tend to graduate from immediate speculative behavior, trading on daily news, into hardened long-term savings or investment behavior.
So these are the veteran investors?
They are. They hold the conviction, and crucially, they hold the majority of the dormant, highly profitable supply.
And what the sources show is that the recent sharp correction, that drop from 126 down toward where we are now, that wasn't just random market fear.
No, not at all. It was the direct, measurable result of these LTHs finally deciding after months or even years of holding that it was time.
Time to capitalize on high pricing.
Exactly. They were selling, it's what we call a major distribution event.
Yeah.
They saw those near six-figure prices and decided, you know what, it's time to take some chips off the table.
And the structural shift that resulted from that decision is huge.
It is. The raw data confirms the conclusion of this distribution phase. Approximately negative 500,000 BTC was released from LTH hands and flooded into the circulating market.
Whoa, wait. Let's just pause there and digest that number. 500,000 Bitcoin.
500,000.
Changing ownership from the most experienced hands to the newest, most, I guess, volatile hands. That is an immense amount of supply. How does a transfer like that compare to previous big distribution events?
This is exactly why the research calls it the Great Wealth Transfer.
Right.
The last time we saw a structural transfer of supply this large was immediately following the April 2021 market top.
And that was a definitive cycle-ending event.
It was. The key difference now is the timing. This is happening mid-cycle, after a sharp run-up but before what you'd call true market euphoria.
So the fact that the market absorbed 500,000 Bitcoin without completely collapsing back into the 60,000s, that says something.
It speaks volumes about the underlying demand. It confirms that this structural supply cleanse is typical of a mid-cycle reaccumulation phase, where profits are taken and the supply is reset for the next big move.
So if the veterans have really released 500,000 coins, does that mean they're functionally done selling, at least for now?
It does. I mean, the interpretation is that the risk of those sudden, large-scale supply injections, whale dumps that everyone fears, from this most convicted cohort, has effectively vanished.
So the supply that was profitable and ready to sell is now where?
It's now in what we'd call weaker, newer hands. They've completed their distribution. The market has proven it can absorb it. And this sets the stage for a period of underlying structural stability, even if the price is still moving around dramatically day to day. The major structural overhang, the LTH supply, is largely gone.
Okay, that's the narrative. But you know us, we need to prove it with data. We need concrete metrics that confirm this distribution is really finished. So let's dive into Coindays Destroyed, or CDD.
Right, CDD is maybe the most elegant tool in the whole on-chain analyst's kit. It doesn't just track the volume of Bitcoin moved, it tracks the economic significance of old coins moving.
Give me an analogy. How should I think about that?
Okay, think of it like this. Every single day, a Bitcoin stays dormant. It accumulates one coin day. You can think of coin days like vintage on a bottle of wine. The older the coin, the more coin days it has, the higher its vintage.
Okay, I like that. So when that coin moves...
Those accumulated coin days are destroyed. The vintage is consumed, so to speak. A high CDD reading means old, dormant, highly appreciated supply. The high vintage coins is being sold. That is the definitive signal of LTH distribution.
Got it. So with that definition, what did we see during the correction? And more importantly, what is the reading right now?
During the correction, we saw a massive, sharp spike in CDD as those veteran investors started selling their vintage coins. But the current reading tells the story of the aftermath. The CDD metric has, and I'm quoting again, violently collapsed back to the historical baseline.
Violently collapsed. That phrase sounds incredibly dramatic. What does that actually mean for the average person watching the charts at home?
It means the selling didn't just taper off gradually over a few weeks. It hit a wall. It effectively vanished overnight.
Like a switch was flipped.
Yeah, exactly. If you imagine those veteran investors as a huge reservoir of potential selling supply, the floodgates opened wide, and then they suddenly just clamped shut. The reservoir is, for now, empty.
And we've seen this before.
Yes. The report notes that these low CDD levels were last seen immediately after major capitulation events. That is, after the final low was put in during previous corrections. So this sudden collapse, it signals a clear selling climax exhaustion.
The veterans who are on the fence watching the price thinking, okay, this is my chance to get out.
They've already executed their trades. They're gone.
So CDD confirms the selling intent and the sudden stop. Do we have another metric that confirms the physical reality of that negative 500,000 BTC supply change?
We do. We confirm this inventory change using the metric called supply last active 1+ year ago.
And how does that work?
It's pretty straightforward. This metric naturally declines when LTHs sell because their previously dormant coins become active again in the hands of the new buyer.
So you saw a big drop in that metric.
A swift, sharp decline. And when you pair that with the earlier CDD spike, it absolutely confirms the physical release of that 500,000 BTC figure we discussed. It confirms the inventory shift from strong hands to new hands is not some theory. It is a measurable, realized event that is now concluded.
The supply cleanse is complete.
It's complete.
Okay, so the past is settled. The LTHs are done distributing their risk on supply. The market absorbed 500,000 Bitcoin. This brings us to the present. And here's where it gets, I think, really interesting. Who caught that supply? And what does their cost basis mean for the rally that's trying to start right now?
This is where we transition. We go from the past behavior of the LTHs to the present structural resistance, which is dictated entirely by this new supply cohort. These are the people who now own that 500,000 BTC, and they are the new gatekeepers of momentum.
So let's define the short-term holder, or STH cohort, clearly.
The STH is defined as any coin that has been moved in the last 155 days. So essentially, this cohort encompasses everyone who bought into the market since the last major accumulation phase began.
They're the ones who immediately absorbed that 500,000 BTC supply shed by the veterans.
Exactly. They are the new buyers who jumped in during all that volatility, betting that the bottom was in.
And the data confirms this is a one-to-one absorption.
It does, which is just incredibly clean data. The STH supply growth metric shows that their holdings have grown by an equivalent positive 500,000 BTC.
So that represents the capital that confidently bought the dip.
Yes, between the peak and the $89,000, $90,000 price we see today, this new supply is now the controlling factor for immediate price movement because they are the ones who are most sensitive to short-term volatility and price swings. They just haven't had the time to develop that same hardened conviction as the LTHs.
Okay, and this brings us to what you call the most crucial number in the entire report, the STH realized price. Let's define this very carefully because it really does hold the key to the next move.
It really does. The short-term holder realized price is the statistical anchor for this entire new cohort. It's defined as the average acquisition cost of the entire new supply cohort.
In simpler terms,
it's the collective weighted average price at which all those 500,000 newly acquired Bitcoins were bought. It's the point where the entire cohort breaks even, collectively. If the price is above this line, the STHs are in profit and they're happy. If the price is below it,
they're holding losses.
They're holding losses.
And that critical number is precisely $104,685. Let's just call it the break-even wall.
I like that, the break-even wall. And that number is 104,685. Now compare that to the current price of around 89.9.
That's a difference of over $14,000.
It is. Which means that virtually all of these short-term holders are currently holding unrealized losses. They bought the dip, and then the dip kept on dipping. They are underwater, waiting for salvation.
This brings me back to my earlier point, though. If the LTHs sold 500,000 BTC at high prices, and all the new buyers, the STHs, are currently holding losses, doesn't that just suggest the LTHs timed the market perfectly and the new buyers are left holding the bag?
It's the essential critical question. You're right.
So why should we trust this is a structural reset and not just a very, very expensive bull trap for this newer group?
Because the LTH distribution is exhausted.
Yeah.
We confirm that with the CDD metric. So the market risk has fundamentally changed. The risk is no longer external, coming from veteran sellers dumping on the market, but it's now internal. It's all about the new buyer's psychology.
And that 104,685 level is the focal point of that psychology.
Exactly. It becomes the most critical area of overhead supply precisely because of this internal psychological pressure.
Can you just walk us through that psychology, what's going on in their heads?
Okay, imagine you're an STH. You bought near the top, say at $110,000. You've watched your investment just erode for months. The moment the price starts climbing and hits 104,685, you are finally back to your average break-even point, or at least close to it.
So you're just relieved.
You're incredibly relieved. This level is where every rally is going to encounter intense, reflexive selling pressure. These STHs, they don't necessarily want a profit. They just want to eliminate their realized loss and get out. They are, by definition, weak hands, and they are seeking the great exit point.
So if we do see a rally, this break-even wall at 104K is where the market will face a huge test of conviction.
A massive test. The requirement for a sustained rally is not just reaching this price. This price level must be broken and then successfully flipped to support.
What does that mean, flip to support?
It means the market needs to rally past 104,685, absorb all of that reflexive selling, maybe correct slightly, and then hold above that level. If it holds above it, it proves that the remaining new supply holders have conviction. It proves they're willing to enter the profit zone and wait for even higher prices.
And until that happens,
Until that happens, 104,685 acts like a giant concrete ceiling, holding the entire market structure down. This is the new structural supply challenge that was created by the LTH distribution.
given that we're facing this massive wall of overhead supply, the natural anxiety for you, the listener, is, are we peaking? Is this a repeat of the 2018 crash? Let's zoom out and use some bigger cycle metrics to prove that, despite the pain, the market is not topping out.
This sanity check is absolutely vital. We use these aggregate profitability metrics to assess where we are in the larger bull cycle, completely independent of the recent volatility. Let's look at the MVRV-Z score first.
Okay, MVRV-Z score. What is it, and what's an analogy we can use to make it instantly clear for everyone?
MVRV stands for market value to realized value. The Z-score just normalizes this ratio, but think of it as the market's engine temperature gauge.
Okay, an engine temperature gauge. I like it.
When the gauge hits the red zone, the engine is overheating and a crash is imminent. The score assesses the overall profitability of the market relative to the total supply's cost basis. High scores mean the market is extremely, dangerously profitable and prone to a massive crash.
So where is the needle on our temperature gauge right now? Is it in the red?
The current reading is approximately 1.24.
1.24. That feels incredibly low, especially since we were just near $126,000 a short while ago.
That low reading is the key interpretation. This score is typical of a mid-cycle or an accumulation phase. If this were a cycle top, if the engine was overheating, we would typically see MVRV-Z scores approaching 7 or even higher.
We saw levels like that in early 2021, right?
We saw levels around 7.2. The fact that we are barely above 1 confirms that the entire circulating supply has not reached an extreme level of collective unrealized profit.
So the engine is cool?
The engine is cool. The structural supply ceiling, the point where the entire market is just too giddy to sustain itself, is still very, very far off. This confirms the correction was a pause, a structural reset, not a peak.
And this structural health check is backed up by another classic metric, net unrealized profit loss, or NUPL.
Yes, NUPL is an excellent sanity check. It measures the total unrealized profit, or loss, held by the market as a percentage. We can call this the Market Happiness Index.
The Market Happiness Index. I like that. So what's our current reading? How happy is the market?
Our current reading is around positive 39.76%.
And what does a plus 39% translate to on the happiness scale? Are we ecstatic? Are we depressed?
It places the market firmly in the optimism or belief-disbelief zone. Think of it this way. The market is happy, but it's still rational.
It's not euphoric.
Not even close. If we look at historical tops, the final irrational legs of the bull market, the market enters the euphoria zone, which is typically anything above a 75% NUPL reading. That's when everyone's talking about crypto at dinner parties and they feel invincible.
We are nowhere near that state.
Not even in the same ballpark. So the data confirms the story. The market has cleaned out the weak LTH supply and is now battling the resistance created by the newest weak hands, the underwater STHs. But overall, the structural cycle has a long, long way to go.
Okay, so we've settled the path. The veterans are out. We've assessed the present. The new buyers are creating the break-even wall at 104,685. But before we move to the leverage, the derivatives, we have one more critical source of organic supply to address.
The miners.
The miners. They are constantly producing new Bitcoin, and their behavior often signals the final capitulation phase of a structural market low.
Exactly. Miners are the constant source of new Bitcoin supply. They solve blocks, they get block rewards. Their business structure means they have fixed operating costs, primarily electricity, that have to be met no matter what the Bitcoin price is.
So their behavior is a lagging indicator.
A lagging but incredibly reliable indicator of a structural market low, because their financial desperation can force them to liquidate coins they would otherwise hold.
Let's look at the hash ribbons then to assess their health. What is this metric telling us right now?
The hash ribbons metric uses the 30-day and 60-day moving averages of the hash rate. That's the total computational power dedicated to the network. When the short-term average, the 30-day, drops below the longer-term 60-day,
That's bad news.
it's known as a death cross, or more precisely, minor capitulation.
And we are currently in a minor capitulation phase.
We are. This is a direct consequence of the price dropping from 126 down to around 90K. For the least efficient miners, the ones operating in places with high electricity costs or maybe using older, less efficient hardware, they are just no longer generating enough revenue to cover their fixed costs.
So they're unprofitable.
They're becoming unprofitable, and they have two choices. They either have to liquidate their accumulated treasury supply to stay afloat for a while, or they have to cease operations completely, shut down their machines.
This sounds like a painful, but again, a necessary cleansing of the system. Why is this important for identifying the absolute structural bottom of the market?
Because this event introduces the final necessary structural selling pressure that purges the marginal players. The conclusion of this capitulation phase has historically marked the final price bottom with very high precision.
So once the least efficient guys are forced out,
The remaining, stronger miners take over their hash rate, profitability stabilizes for everyone who's left, and the hash ribbons reverse. And when we see that reversal, it reliably signals that the last of the organic selling pressure from the production side of the Bitcoin economy has been purged.
it means the market has reached a state of near-perfect structural cleanliness.
That's the idea.
So we are still waiting for the hash ribbons to reverse, which suggests we are in the middle of that final purge right now. How long does a capitulation phase like this typically last?
It can vary, but historically, these mid-cycle capitulations can last anywhere from 30 to maybe 90 days. It all depends on how stubborn those marginal miners are. This is why their behavior is a lagging indicator. The price tends to put in a bottom during the capitulation, and the reversal signals the all-clear afterward. Right now, the data confirms they are absolutely struggling.
And is this stress reflected in the movement of their actual Bitcoin holdings? Can we see them selling?
We can. If you look at the miner net position change, the data shows a clear increased outflow from miner wallets.
So that's proof.
It's proof that they are actively distributing their newly mined supply, and in some cases, dipping into their existing treasury stacks just to cover operating costs and stay in the game a little longer.
So let's recap the spot market. We have the veterans out, we have the new buyers underwater, waiting to sell at 104K, and now we have the miners selling just to keep the lights on.
Precisely. This represents the final structural selling pressure before the spot market supply side, from all three major groups, is completely and utterly exhausted.
And once the miners are finished selling their essential supply.
The only structural resistance left is the break-even wall of the STH cost basis. The spot market is setting up to be exceptionally lean on supply, which is a perfect precursor for a sudden, aggressive move.
Okay, we have analyzed the entire organic spot supply market, and the consensus is that it's structurally exhausted and clean. But Bitcoin doesn't exist in a tidy little bubble, does it?
No, it doesn't.
It lives in a highly leveraged environment where technical forces can overwhelm those organic supply dynamics in an instant. So now we shift our focus entirely to the high-tension derivatives market. This is where the short-term chaos and the potential for a massive move is being built.
And this is what the report calls inverse supply. The derivatives market doesn't offer physical Bitcoin supply, but it offers technical liquidity in the form of forced buy or sell orders that can rapidly overwhelm anything happening on the spot market.
So if the spot market is structurally cleaned,
The derivatives market is currently wound tight like a spring, just loaded for a dramatic release.
all right, let's quantify that tension using aggregated open interest, or OI.
Open interest is the total level of outstanding leveraged contracts. It's the sheer amount of capital betting on price movements. It's the measure of how much financial energy is trapped in the system.
And the current reading.
It is exceptionally high. We're looking at around $28.89 billion.
$28.89 billion in leveraged exposure. That sounds like a powder keg.
It absolutely is a powder keg. When you have such high OI and the price is just moving sideways like we've seen around this $89,000 to $90,000 level, you create what they call the loaded spring effect.
Describe that for me.
The market is just saturated with both long and short positions, all trapped in this tight range, waiting for the first sign of a breakout. When that spring finally releases, the resulting price move will be disproportionately violent.
Why so violent?
Because all those leveraged positions are interconnected. A small move in one direction triggers forced closures liquidations of the opposing bets, which then acts as a self-fulfilling prophecy, amplifying the momentum instantly.
So the energy is there. But we need to know which way that spring is most likely to unwind, up or down.
And that's where the perpetual futures funding rate becomes absolutely critical. This is the small payment mechanism that keeps the perpetual futures price tied to the spot price. It dictates who pays whom to hold leveraged positions.
And the current reading is?
Slightly negative.
Okay, what does a negative funding rate signal about market sentiment?
A negative rate signals that shorts are paying longs to keep their positions open. Now, just think about that for a second. The short sellers are so confident that the price is going to go down that they are paying a fee, a premium, just to maintain their bearish bet.
That reflects high demand for short-side contracts. A lot of fear.
A ton of market fear, or just excessive greedy shorting.
But why does this configuration create what you called a synthetic buy-side liquidity supply? That sounds like contradiction.
It does, but here's how it works. Every single short position, every bet against the price is a guaranteed eventual buy order. There's no way around it.
Because they have to buy back to close their position.
Exactly. And if the price moves against the short seller, they are forcibly liquidated, meaning their exchange closes their position by buying Bitcoin on the open market, whether they want to or not. So when the funding rate is negative, and you have this huge concentration of short positions,
You've built the forced fuel for a massive short squeeze.
you've got it. The market has essentially engineered a huge amount of hidden, guaranteed buy pressure just waiting for a simple trigger. This is precisely why the report describes this configuration as the optimal setup for a rapid vertical ascent.
It's so counterintuitive. The more bearish the leverage gets, the more powerful the inevitable upward move becomes.
Exactly. It's inverse supply. The market is trying to buy supply by selling futures contracts, but by doing so, it creates this massive technical demand just waiting to be activated.
And we can even pinpoint where that fuel is stored using the liquidation heat map. This is where we can see the exact price levels where all those shorts will be forced to close.
The liquidation heat map is like having X-ray vision for the market's leverage.
Yeah.
And the observation is clear and immediate. There is a massive, dense cluster of short-side liquidation leverage, those forced buy orders, stacked like a wall right above the current price.
It's not spread out.
No, it's not distributed gradually at all. It's a tight wall of necessary purchases. We can call it the liquidity ignition cluster.
And what is the specific price range of this cluster? Where is the wall?
It primarily spans the $90,000 to $98,000 range. If the price can just creep above $90,000, it hits the base layer of this cluster. Once that layer starts liquidating, the resulting forced buying pressure immediately accelerates the price up toward 98, liquidating the next layer of shorts, and so on and so on.
Okay, let's synthesize this whole picture now. We have structural exhaustion on the spot side. The LTH selling is completely finished. And we have high negatively biased tension on the derivatives side.
The synthesized conclusion is that the derivatives market has manufactured a huge amount of technical buy supply between $90,000 and $98,000. If the spot price can just breach 90K, the resulting forced closure of shorts will act as a liquidity ignition, rapidly accelerating the price.
And that sudden violent surge of buying would immediately target
The ultimate structural supply barrier we identified earlier, the STH realized price, the break-even wall at $104,685.
So the leveraged market is providing the massive momentum needed to overcome that psychological barrier created by the new dip buyers.
That's the setup. One is the fuel, the other is the target.
Okay, we've broken down all the inputs into this entire structural analysis. We know the veterans are done. The new buyers are sitting on losses, eyeing 104,685. The miners are selling their last bit of supply, and the derivatives market is loaded with short fuel between 90 and 98K. Now, let's synthesize these findings into specific, actionable price levels that matter most to you, the listener.
The key insight, really, is that the structural elements of the market are now reset and fully loaded. The heavy LTH selling is gone. The primary conflict in the immediate future is a battle between two giants: the overhead resistance posed by the STH cost basis at 104K and the massive derivatives short fuel waiting to be ignited just above 90,000.
So which force is currently set up to win that battle? The organic selling pressure from the STHs or the technical buying pressure from the short squeezes?
Well, the analysis clearly indicates that the overall supply structure currently favors an aggressive upward movement once that initial buying pressure is established.
Why is that?
Because the supply that could be sold, the LTHs, is exhausted and gone. And the supply that must be bought, the forced short closures, is highly concentrated, it's leveraged, and it's huge. The technical leverage simply outweighs the organic spot supply risk right now. This structural reset has cleaned the slate, and now the technical setup is optimized for momentum.
Let's define the three critical price points we all need to be watching in the coming days. First up, the imminent catalyst. The short squeeze ignition.
The trigger price to watch is a decisive price move above $91,500.
91.5. That's the key that unlocks the derivatives market momentum.
It's the tripwire. It's what begins the cascade.
And what is the immediate effect of crossing 91,500?
That will trigger the initial necessary short cascade. Remember that dense wall of short liquidations between 90 and 98,000. 91.5 is the level that activates that huge supply of leveraged buy-side liquidity, turning market momentum instantly positive and vertical.
And this will not be a gentle ascent.
No, it will be a high-velocity, forced rush to cover.
Okay, next. The ultimate objective of that rush. The structural resistance. Where does the resulting rally immediately target?
It will immediately target the break-even wall, the $104,685 STH realized price. This is the final supply hurdle. It's the price that separates this current pause phase from the next sustained bull market leg.
And what must happen at that price for the rally to actually be successful long-term?
Like we said, that level must be broken and successfully flipped to support. If the market can pass 104,685 and hold it, turning the new buyer's losses into profits, it moves that current overhead supply into a structural support zone.
Which would signal that the market has fully absorbed both the veteran supply and the new STH supply.
And that clears the path for the next sustained leg of the market to challenge all-time highs.
Finally, we have to analyze the key downside risk. What happens if the structural cleansing fails and the short squeeze never ignites?
That risk scenario is defined by a break below $88,000. We have to watch that level very closely.
If the price falls below 88,000, what does that imply about the short-term holders?
It would suggest the STH cohort is undergoing a final deep capitulation. Their conviction has failed, and they are now selling their coins at a significant loss, just dumping the supply the veterans handed them.
And that would force a deeper search for liquidity.
It would. It would likely target the next major support band, which the analysis identifies as being in the $82,000 to $85,000 range. This would signal a longer, more painful reaccumulation phase where that STH cost basis moves much lower.
But given the extreme tension in the derivatives market,
The upward ignition scenario currently carries far greater technical probability.
so what does this all mean? We started this deep dive with the idea that the recent volatility wasn't a crash, but an inevitable mid-cycle structural reset. And the data, tracking the supply from strong hands to weak hands, really seems to confirm that structural purge. The market is fundamentally cleaner than it was 3 months ago.
And this leaves us with three major forces in immediate conflict, setting up a definitive showdown. The structural exhaustion of the veterans is complete. The new buyers have built a massive psychological wall of resistance at 104,685. And the derivatives market has manufactured a massive loaded spring of forced buy pressure right above us, between 90 and 98,000.
The structural analysis really suggests the spot market is cleaned out and loaded for an upward move, but that next phase requires a psychological break of the new buyer's cost basis. The battle is a classic one: forced technical action versus voluntary psychological resistance.
Indeed. And we highlighted that the current price level is experiencing selling pressure from two distinct organic groups: the least efficient miners selling just for solvency, and the newest buyers holding unrealized losses. While the veterans are out, the true test of market conviction is whether these newest participants will hold through their break-even point, or if they'll liquidate.
Which raises an important question for you to consider as you watch the charts. In this mid-cycle reaccumulation, who will win the final battle for control of supply? Will it be the weak hands exiting at 104,685, successfully capping the rally? Or will the immense volatile force of forced short closures accelerate the price so violently that the break-even wall is simply shattered? A decisive move above $91,500 will tell us everything we need to know about the winner of this supply war.